Welcome back to the channel, guys. Today we're talking about ticker ACRE. We're doing a 5-minute DD video on this popular REIT that currently is yielding about a 13.5% dividend. It is a pretty high dividend and it's a very interesting company. It kind of partnered with ticker ARCC, a very popular BDC, and we'll talk about that. What we're going to do first is we're going to jump into their recent investor report. So let's go over and do that. So we'll jump in. Again, this is their second quarter earnings from 2023. I'm going to scroll down here. We can see some of the highlights that they talk about their loan portfolio, which is pretty interesting. They have senior loans at 98% of them, which is important. Senior loans are typically better. You get paid out if the company does poorly, or say a company files bankruptcy. When you have higher level senior loans, you're more apt to get paid first, thus mitigating some of the risk. 2.3 billion outstanding principal balance, huge balance there. Earnings, they paid out 35 cents in distributable earnings in Q2, which is pretty consistent with what they have been paying, and the declared regular dividend of 33 cents. So ACRE actually pays out 33 cents and then does a 2% special dividend, I believe. I'm not sure why they do that, but they've been continuing to do that for quite a while. And so their dividend yield is pretty remarkable at about 13.47%, I want to say. Now, balance sheet positioning, really important here is their net debt to equity ratio. For those of you that don't know what this means, typically the range that you would want is about a 1 to a 2. The higher you get is riskier because it means you have more debt versus equity when you're talking about a company. Now, the bigger a company gets, if you have too high of a debt to equity ratio, what that basically means and can mean is that you have higher risk. It's going to be more difficult for you to pay off your debt based off of equity. So 220 million of available capital, very interesting. I'm curious to see if that's gone up or down over the past couple of years, seeing how they're investing. And the Aries sponsorship, lots of stuff going on there. Huge. We'll talk about their portfolio here in just a minute. Looking at their overall Q2, net loss of 0.04 per diluted common share. So a bit of a drop there. Not really surprising in that sense. Closed 49 million in new loan commitments with 80.5 million in outstanding principal funded, 51 million in loan repayments and sales, which is pretty remarkable. 51 million paid back in repayments and in their sales. So definitely good. 27.2 million defaulted senior office loans at a net price equal to loan. This is a lot of financial jargon, guys. Bear with me with some of this. Available capital of 220 million, like we said. So they do have a lot of money to invest if they choose to. And that is good. That is definitely a good thing to have more cash on hand. They did some repurchases of about 535,000 shares of common stock. I really like it when companies like this do repurchase their common stock for a number of reasons. It is very important to keep shareholders happy, and 4.6 million repurchased is good, and it's a good sign for the company, especially just overall for under a lot of things. So looking down, they talk about asset type. We'll talk about this when we look at their full portfolio breakdown, which is really important, guys. If you're looking at REITs, you really want to know their asset breakdown. Tons of different charts and whatnot. Again, you guys can go check out all of this stuff. If I'm going too fast for you, go check out on your own. They all of their new investments for 2023 Q2 were senior, which is good. Percent of portfolio only 2%. So they do have a pretty good market cap of about 550 million. Total capacity across all financings 2.3 billion, outstanding principal borrowings 1.7. So that is a very high amount, but you do want money loaned out. We see that net debt to equity ratio, very important standing. And now their dividend coverage, what we all came here to look at, we can see that the regular dividend and then the supplemental dividends declared, and it has just continued to grow. A very impressive growth, I might add. They've paid per share, $1, and then continuing up to where they're now paying, let's see, Q2. So for 2022 per share, they did pay out quite a bit. They're not paying this much. I'm curious as to what this chart means exactly, because they're definitely not paying $8 a year per share when their quarterly dividends are 35 cents. Maybe one of you guys can help me explain that. This one always has tripped me up a little bit. Distributable earnings versus cumulative regular earnings. So basically, oh, I see. So they're going up a little bit with the cumulative supplemental dividends. And then the appendix and all of this, all their interesting information there. So now what we'll do, let's go look at their portfolio and see exactly where all of their investments are. All right, guys, so portfolio composition. This is as of June 30, 2023. Credit priority, senior mortgage loans. We talked about that. Really good gives me a more safe feeling when I'm thinking about investing in a company, knowing that the loans are senior mortgage and that they have a better chance if something does go wrong with the company or with the loan. Now, really important, property type distribution. So the pandemic really put a wrench into a lot of plans with these kinds of things, and it's important to have very good overall spread with the property types you're invested in, and that's what I really like about ACRE is they have that. So we see right off the bat 38% in office spaces, which is typically really good. If you had asked me 3 years ago, I'd say that's phenomenal. Office spaces are consistent. A lot of companies rent out office spaces and whatnot, and if you upkeep the building, then you're set, and I like that they have a large portion of office spaces. With everything switching to kind of remote work for a while there, and now people are kind of going back to the office, that is a little bit more risky than it would have been in, like I said, a couple years ago. But still, overall, if you have good management, you should be able to fill those spaces and keep the money flowing in. Next is multifamily, another amazing one. I plan on investing in multifamily properties eventually here. 23%, pretty good. Pretty good. I would like a little bit more in multifamily and a little bit less in office spaces. The thing with multifamily is there's typically more risk. And what I mean by that is depending on the type of multifamily, whether it be a higher end multifamily or a lower end multifamily, you could have different problems with tenants, with the location, with all things of that sort. With upkeep, they're probably using property management companies if they don't do it themselves. So there can be a lot of factors that go into multifamily, and that's why they're typically riskier, whereas office spaces are probably a little bit safer but more expensive. And then, of course, you have hotels, mixed use, industrial, student housing, self-storage, love self-storage, residential, condominiums, 7%. So geographic composition, this is actually really important. So Southeast, 27%, Midwest, 19%, West, 16%, Mid-Atlantic, Northeast, 28%, Southwest, 11%. So they are pretty diversified all over the place, with most of that being in the Mid-Atlantic and the Southeast. If you're looking at these different property type distributions, you may want to note where they are. With multifamily and stuff like that, the locations can be important, and with states like California, there's rent can be higher. New York, rent can be higher. So depending on where these are, how profitable these companies are, as well as the overall increase in value of these properties, because of course some areas recoup value a lot faster than others, and so it's important to note. So dividend history, one of the most important aspects of a dividend stock in my opinion. Hi guys, I'm showing my face for a second here while we go over this. You can use Seeking Alpha. This is what I typically use. I like it a lot. You can look at a lot of the metrics on here too, double check them. So the interesting part, so this chart shows their regular dividend, and it looks like there's been a cut. There hasn't been. They haven't paid out their special dividend. I'm not sure if they're going to do that. They just haven't paid it out yet. Only time will tell. If they don't pay it out, kind of a bummer, but nothing too crazy. It's only about 2 cents, but I do like the special dividend. We can do their price percent or their price and dividend history every time the dividend's paid out, what the price does. So they have been on a bit of a downtrend, but the dividend has been consistent. The adjusted amount, 33 cents, all the way back to 2018, where they jumped it up quite a bit, and then continuing back. So they've been growing it since about 2012, almost a little over 10 years, but they haven't fully grown it since about 2018, which is noticeable. The markets have been a lot more all over the place since then. Let's check their dividend growth. We can see a lot of stuff here. They haven't had growth, of course, because like we just saw, they haven't been increasing that dividend the last couple of years. But there is a ton of information on here. You can see their 5-year paying out $1, $1.40, $1.40. You go to the 10-year, they started out at $1, they're up at $1.40. So I love CAGR, compound annual growth rate. They have been doing relatively well until 2019. So their yields have been coming down a little bit, it seems, but year-over-year payout did take a jump in 2019. I don't know why they don't have a more recent history with this kind of stuff, but you get what you get. I'm not in the paid version right now, although I might even have it. So overall, definitely an interesting company. I did say I would talk about it. So ACRE is the external management company of ticker ARCC, Ares Capital Corp, a really popular BDC that's even larger, I believe, in market cap, and they've been doing well for them. The two aren't necessarily linked together financially. I guess you could say that ARCC pays ACRE, which they do, of course, as an external management company. But just something important to note, I really like ARCC. It is one of my favorites. I do not own ACRE yet, but I'm going to be watching it really closely, and I think it might be fun to throw it into our next dividend account challenge. So if you guys are interested in that, let me know. I appreciate you guys. I've been all over the place. I've been working crazy overtime. I've been starting a different small business as well, so my YouTube has taken a backseat to that. But I'm planning on putting out more videos. And as always, if you guys help me by supporting, by watching, all that kind of stuff. We're kind of on the road to 1,000 subscribers. I think we're about 600 right now, which I really appreciate you guys. All the comments you guys leave talking about different stocks, it helps me research more, find different stocks that I wouldn't normally have heard of. And so I do appreciate that from you guys. And as always, if you guys want to join the free Discord, we go in there, we talk about stocks, talk about news events, talk about the market overall. The Hound is his name. He's in the Discord. He's been doing a bunch of stuff for us, which I really appreciate. He made it look amazing. So go check it out. Let me know what you guys think. Comment your favorite dividend stock in the dividends server portion. As always, guys, like I said earlier, thank you. Like and subscribe if you're interested in more content like this, and I will see you in the next one.